My name is Michael Guyett, publisher of the Lead Lag Report. Is joining me for the less than hour, given the truncated space here. Greg Harmon, who I've interacted with and met many, many years ago. Greg, for those who are not familiar with your background, just introduce yourself. Who are you? How did you get involved in markets, and what are you doing with your firm?
Yeah, so my firm is Dragonfly Capital. It started out when I got laid off from Wall Street in 2009. Started posting charts and my interpretation of charts on Twitter at that point in time, which led to creating a blog, which led to selling a blog and subscribers, and those subscribers are getting trade ideas. Every Sunday, I send out 10 ideas from a technical analysis perspective on how to trade these ideas using both the stock and option strategies. That has led into managing money for clients as well through a separate business, Dragonfly Capital Managed Accounts, for those that liked the ideas but didn't have the time on their own. My background before that was 25 years on Wall Street, sometime at JP Morgan, sometime at State Street, and the last stint was at BNP Paribas. A lot of dealing with stock, international stock, U.S. stock, and equity options as well. So my focus is technical analysis and equity options.
Okay, so now, you and I are both CFA charter holders. I've done quite a bit of work with the CMT Association, and you are wildly ambitious in that you have both designations. I'm curious to hear your thoughts on which of the two programs was more challenging and which is perhaps more applicable from a portfolio management perspective, because you're talking technical,
Sure.
which sounds much more CMT, but asset allocation, I'd argue, is much more in the domain of being a CFA charter holder.
Right. So for me, it was I moved back to the States from London in 2000, and was looking to kind of prep a career moving into investment management, and in Boston at the time, and it was a matter of you needed a CFA to get in the door there. So I started working on that at that point, and the bank put me through that. I didn't know what a CMT was at that time, but I knew I was practicing technical analysis already. So the CFA was difficult. Yeah, it's a very rigorous set of exams, and those of you that have gone about doing it, you know that. But for those that are on here that maybe are not so familiar with it, it tends to have a pass rate of less than 50% in the first round, and even worse than that in the second round, before it jumps up quite a bit in the third round when you finally can say that you've passed the CFA exam. The CMT for me, because I had been practicing it for 20 years, was not such a big deal, and kind of breezed through those. But there were aspects that I don't use that were kind of interesting to spend some time learning about, like point and figure charts and some other algorithmic type aspects of it. But from your question there, Michael, about which is more useful. I think that you need to have the fundamentals. You need to have the ability to analyze stocks to be able to get into a portfolio management situation. And once you're in that portfolio management situation, you've gone through and you've analyzed stocks, and you said, I want to buy this stock, and I think it's going to go up to this value, or I think that it's going to go down to this value, and you've got the kind of fundamental perspective on it. What you don't have is the timing on it and the risk management aspect of it, which is, I think, is the biggest value that comes from the CMT side, or the technical analysis side. Having the ability to kind of put the timing around it and understand where you might be wrong too, so that you're not just sitting in a stock that's going to go lower for another 10 points, even though you believe that the story that it's going to increase in value by 50% over time. Why buy it today if the technicals are telling you it's going to go lower by 10 points and you can get in at a better price in the future? Just because you've done your analysis doesn't mean that because you finished your analysis today that this is the right day to go in and buy.
The criticism around designations like the CFA charter in particular really relate to this idea that evidence supposedly suggests that having a CFA charter doesn't necessarily make you a better portfolio manager in terms of generating more alpha or more return. And I probably am going to assume it's maybe a similar dynamic with the CMT designation. And I can understand that reasoning to an extent, right? It's kind of like, what do you call the person that graduates last from medical school, right? It's doctor,
Yeah,
right? It doesn't really
exactly.
tell you much, right? But
Right.
if you were, but I often go back to, whenever somebody critiques people like you, people like me who spent the time and effort, that having the CFA charter or CMT charter doesn't necessarily tell anybody anything about our skill, but it does tell people about our work ethic, right? Because it's a hell of a grind to go through that process
Hmm.
of the exams and studying and doing that. Obviously, when you have a career, um, as you look back, do you think that getting the CFA charter, getting the CMT designation were worth it from a career perspective, right? Because you started your own RA. I mean, you're doing it now. You're out there and managing money, and you've got your content. But do you find that the designations help in terms of brand building or business building?
I don't think that the designations are that important in terms of brand building and business building, unless. Well, let me restate that. If you're just starting out and you don't have some kind of designation, it's difficult to build a following, right? It's difficult to start building a brand. So that kind of like your example with what do you call the last guy graduating med school? There's a filter that gets put in there when you can say that you are a CMT or you've got a certified financial planner or whatever it is that you're trying to do. That filter shows that you've at least put some effort into what it is you to and in, and not just someone that's woken up in the morning and decided that they were going to start this business. So I think that's the biggest piece of it. Once you patient, then it becomes, I think, less important in terms of increasing and expanding what you're doing.
Okay, so that then lends itself into a conversation around market movement this year. So you said, CMT tells you, and when you think about stock picking and trading, you have to figure out the timing and the risk management. And it's funny because I think people think of timing as a way of getting better returns. I'd argue timing is more about managing risk than actually getting better
Mm-hmm.
returns, right? Because in the long run, at least in theory, right, stocks tend to go up, which means timing is not so important for the upside, right? Much more for the
Right.
downside. So in a year like this, where seemingly everything looks very desynced, and we'll talk about bonds and stocks here for a moment. How do you think about timing when you're in a cycle where it seems like no matter what particular asset class you're trying to time or stock you're trying to time, it's like an uphill battle to try to actually manage risk when there's risk everywhere.
Yeah, and you can actually help yourself out just by going back to like some of the basic core concepts of technical analysis and how do you identify a trend. So that I look at things like the S&P 500, which had been since the COVID low in March of 2020, making higher highs and then higher lows on the pullbacks, and continued to do that up until the end of 2021. And when we hit that high of the year, the beginning of January 2022, pulled back, made a low, and then bounced to a lower high and a lower low, and that's a signal of a trend reversal right there. So that you're not necessarily going to pick the top and be that accurate by understanding basics about a technical analysis, but as you said, you do provide some risk protection, some risk management around that. Just even with the most basic concepts about things are developing lower lows and lower highs. That's not the direction you want to go.
And it's interesting, right? Because the CFA curriculum would argue that volatility is risk. You often hear that. That goes
Mm-hmm.
back to even my finance days back at NYU. And I've always made this point that volatility is not risk, it's really doubt. Although when you're in highly volatile states, there is a risk of a tail event.
Mm-hmm.
Um, let's talk about for a moment volatility in the context of fundamentals and technicals. Do you factor in volatility of different asset classes when you're thinking about individual stocks that you're picking? Are you totally ignoring the volatility dynamic and simply going based on the way a particular chart looks for an individual company. Talk about if you consider the kind of volatility regime as part of your process.
Yeah, so if you look at any stock right now, and I would even use an example, the SPY, uh, the size of the candlesticks that are being printed now are much wider, much larger. We've had like 100 different days this year where the S&Ps move more than 1% on a day. So that's not a normal thing. That is your increased volatility, right? You can still, within that volatility, within that regime where the volatility is there, discern what the trend is. And then it's a matter of managing position size to impact the differential for the possibility are in general going to be bigger now than they have been over the past. So you look at things like the June bottom and a move up, and finally the first time that the SPY made a higher high at as a potential for a trend reversal. And even with the pullback we have now, as long as it stops at a higher low, we have that potential for a trend reversal. But you can't just like toss all of your money back into the market, because we've got these big range days, like our 3% day last week, which means that instead of exposing yourself at a 2% position for an individual stock, maybe you want to do it at a third of that because of the volatility, so that you can limit your losses.
Right, and that position sizing point is an important one. It's like I keep making this argument that what you own matters a lot less than how much you own of it, right?
Yeah.
When thinking broadly, and too many people focus on a chart and buy here, sell there, but you rarely hear people talk about their managing of how much to allocate to that particular stock idea. Now, on the volatility side, the issue with volatility, as you know, is that correlations tend to go to one when you're in a highly volatile states, right, in the stock market, which is funny to me because people say when you're in a bear market, oh, this is a stock picker's market. And my response is, how can it be a stock picker's market if everything correlates more tightly in a bear market?
Exactly.
It's
Yeah, I
really
mean,
logical, right?
we've been seeing that. We've been seeing it for like 3 or 4 months now. And now it's like from a chart watcher's perspective, from a TA perspective, every week, but the analysis that I put out, it's basically the same content for the SPY, the Russell, and the Nasdaq. They all look the same now. Like you said, all the correlations go to one, and when there's a hugely volatile market.
So, what do you do when you're in that kind of a period? So, you've got, you do several ideas for stock charts, 5 charts or 5 stocks that you kind of pick that are interesting to you. But how do you think about that dynamic, right? Because you can choose all these great chart setups, but at the end of the day, beta is going to swell any kind of conclusion you might have about the likely path.
Yeah. So looking at it then from a short-term perspective, you've got this idea of where the trend is going, right? So from January back until we were definitely in a downtrend, but there are bounces along the way. So what do you look for? You look for stocks that have other characteristics other than just straight price activity. So things like momentum that show that they're in ranges where they've got a lot more room to run to the downside than other stocks do, and look to take advantage of them on the downside, or when we're in a bounce back up, like from June through to middle of August. Look for those stocks that haven't quite turned around yet, but are on the edge, and not necessarily buy them, but look for them to make some kind of a significant price move. So over some kind of resistance level, or show that they've confirmed a reversal, that they have more room to catch up to those ones that have been like the average stock or the leaders along the way.
Both long. And so this, I knew this was going to be the question. I think this is a good discussion because this lends itself into not necessarily the idea of stock picking, but leverage picking. Right? When do you think about leveraging a particular theme, or even heavily overweighting it in the context of that? So, talk about how you think about leverage in portfolio. I know with SMAs, obviously, in many cases you can't necessarily do that, but leverage is obviously used by a lot of individual traders, and as a technician, sometimes you want to leverage a particular theme or idea. So, talk about how you think about leveraging, and what are the what are the maybe not so obvious pitfalls, which is kind of a me alluding to the idea of path?
So when I look at things like the SSO or the QLD, I look to how they're set up and how they're created, and that the fees inside and the tracking errors that come about with these things suggest that to me at least, they're not worth participating in it except for very short term periods of time. That over long periods of time, you're set up to have some decay in the value relative to the index. So I stick away from all of those leveraged ETFs. If I'm looking for leverage, I'm going to find it in the options market. So if we go back to what we were talking about a couple of minutes ago about position sizing, if I'm willing to buy 100 shares of Microsoft stock and have a stop loss on it that's $2 below, I might be even more willing to buy a near the money call option that is also going to cost $2 at the same kind of position size and have a lot more leverage involved in that position than I would if I was just buying the stock. So that's how I would look at using leverage in my portfolios.
Yeah, and I'll add to that because I put out a paper that won the 2016 Dow Award called "Leverage for the Long Run." So there's the path point I was trying to allude to is something which few do understand. Using that line I keep saying on Twitter, the problem with leverage is volatility kills you when you have leverage. It's not so much about direction; it's about volatility. So usually, when you're in low volatility regimes, and you know this, Greg, from a technical standpoint, you tend to have more streaks. You tend to have more consecutive up days in performance in whatever asset class you're looking at. Whereas if you're in more volatile regimes, you tend to have more seesaws, big up, big down, big up, big down.
Yep.
Right. So the problem is when you have these big up, big down sequences day after day after day, the daily reset of these types of leverage funds, that's what kills you. And I always reference this point that in 2008, there was a juncture where on a year-to-date basis in 2008, the 3 times levered long financials ETF, FAS, and the 3 times levered short ETF, inverse ETF, FAZ, one long, one short, both 3x. There was a point in 2008 where they were both down like 70%.
Yep.
One's long, one's short. How could it be that they're both down 70%? Because it's not necessarily about the direction; it's about the volatility within that direction. So that the whole point of that paper, if anybody's curious, it's available on ssrn.com. It shows that if you lever when you're above a moving average and you deleverage when you're below it, that ends up being far better than a constant leverage strategy because usually when you're above a moving average, volatility is lower, which means again you have more streaks. The daily reset dynamic helps you now, but that does become an interesting derivative question, which is, well, what about having constant leverage on equities and constant leverage on treasuries? Because, from a portfolio construction perspective, I've done tests on that. That tends to work pretty nicely because usually treasuries benefit from equity volatility, except this year, right?
Yeah.
So let's talk about that dynamic for a bit. I've hit on this point many times over that this year is unequivocally an anomaly. It's not just about 60-40 having its worst start to a year pretty much ever in history. It's more about the sequence interaction of treasuries to equities. I don't know if you use treasuries at all from a tactical perspective, Greg, but when you look at the carnage that happened in the bond market in the context of what so far is not tremendous carnage in large caps, does that concern you that there could be a spillover, meaning that bond market volatility will at some point have nasty ramifications beyond what we've seen in equities?
Not necessarily. I look at what's going on in the bond market. I look for big themes. And I think that what we've seen in the bond market is that, we've had a 30-year bull run in the bond market, and it does seem like it's turning now. And that's a big macro theme that if it continues to turn, that is sitting out there amongst what's going on, prior to talking about inflation and prior to talking about what the Fed might do. It's all couched in that long-term theme of we're not in a 30-year bond bull market anymore. So that there's other aspects I think that are adding to the downside for the bond market. And so that's my perspective. I don't actually add or subtract bond exposure to the portfolios that I'm running. The people that are hiring me to manage their money are looking for me to do equity and option activity, and that's about all that they want from me. I tell them up front if they are looking for some kind of a balanced portfolio or any kind of financial planning, that's not what I'm. When you decide how much money you want in the equity market, I'll help you manage that aspect of it.
All right, so that actually dovetails nicely with Moheb's question, who was going to come up here, but I'm going to read it from his DM to me. He's asking, is now a suitable time to start investing in equities, VU or the Qs or any kind of large cap type of proxy with dollar cost averaging, or do you think it makes more sense to wait to see if the market goes down? Let's first, for those that are not familiar with the term dollar cost averaging, talk about what dollar cost averaging is. And from the vantage point of your position running money, when you get a new client or you get new capital, what do you do with it?
Yes, but I'm very slow to deploy capital once I get new capital. We're in a really strong uptrend. So in an environment like now, I was talking to someone yesterday about adding new capital. I said, in this kind of a highly volatile environment, and we're not confirmed that we're out of a downtrend yet. Take your time thinking about what you want to do. Take your time getting ready for this, because I'm not ready to deploy any of your capital at this point. What else were we talking about there? The dollar cost averaging. Yeah. So my perspective and my horizon in trading for these clients is not a long-term horizon. So dollar cost averaging is not really a tool that I use. In my other life, my other role as a professor of banking and finance at Case Western, I tell students that are 22, 23 years old that they sure as hell damn well better be putting money into the market right now, because they've got 40 years and the market goes up a lot more often than it goes down. If you look at the technical aspects of it, we hit a plus 20% drop in the S&P and then retraced more than half of that. And never in the past have we gone into a bear market, retraced more than half of that, and then gone back to retest the bottom. So it's got historic precedence. We all know correlations may just fade over time, and that may never stick up again. But every time we've dropped over 20% and retraced more than half of it, it's been a good thing to get back in after you've had somewhat of a pullback. And we're now retracing half of what the bounce was from June to the middle of August. So I think it's a good time, if you're a long-term investor, to start putting some money in.
I also think it's important to distinguish between dollar cost averaging and buy the dip, because I think people often think it's one and the same. Dollar cost averaging has nothing to do with, right. And it's like, first of all, the term buy the dip has always driven me utterly insane, because if you're saying to buy the dip, that means that you had cash to buy the dip with, or you're leveraging, which means you're already maxed out. So what's the point if you can't buy the dip because you don't have any cash because you never bought the prior dip, and then 100%, right? So dollar cost averaging is systematic in that sense, right? And you ideally want, actually, if you're a true investor, you want actually prices to go down, which it sounds really counterintuitive, but dollar cost averaging works best when you're averaging lower, because time is on your side to ultimately go higher, right? But again, few, I think, really kind of understand or appreciate that.
Yeah, I would say the second question first. Is it better to day trade those leverage ETFs? I think that's the only thing you should ever do with the levered ETFs is the day trade. You're only dealing with the intraday trend, and you don't have the reset issues, and you don't have that long-term decay that's in place. So I don't think that there's ever a reason to have a position trade on. So, and if we want to put a time frame on it, I wouldn't ever trade the SSO or the QLD for something longer than 2 or 3 days. So the next one then is, how do you know when capitulation has happened first? And for me as a technician, I will take a look and say, if we started bouncing and then we undercut and create a lower low, then there's no reason to deploy any capital at that point. The only reason to deploy capital on the long side is when you first make that higher high, so that if we look at the low that happened on June, was it 17th or something like that, and the move up higher, there was really no technical reason to deploy any capital until we got over 416 around the 9th of August. And at this point, maybe we've got just a false breakout and a reset lower. But from a capitulation perspective, there's no reason to be out of any position that you put as a long-term buy in that period from like August 9th to August 16th. There's no reason other than stop losses for individual stocks to be out of a long-term buy until we undercut the June low. And it's confirmed that we are ready for the next leg down.
By the way, on that point about the capitulation, I think that's also maybe an interesting discussion, because capitulations happen fast, right? So when you think about deploying capital in what looks like a capitulatory move, sort of the final washout, would your perspective be to, you have a watch list of individual stocks, you start buying the individual stocks, or do you simply want to get as much beta exposure as quickly as possible with an ETF? Because I think probably more people increasingly are using ETFs for that fast exposure when there's some kind of extreme than
Right.
deploying some
When
kind
you haven't had the time to
right, exactly
do
right.
full analysis on all the stocks yet, and I do something like that. But I also look at some of the what have been the high flyers and what have been the leaders in the past, and so I'll look at things like Amazon and Apple that have pulled back as a way to get that fast reprint too. So and it's probably kind of the same sentiment, right? As traders are using ETFs, broad-based market index ETFs, to get that fast exposure. Those that are not going into the ETFs are thinking about, what's a really quality name that's been beaten up that's going to bounce back too, which is kind of the same thinking, right? Yeah, so there's a couple ways that can go, right? I'm of the perspective that we've put a bunch of stocks now into what we've called the technology sector. That the technology sector has been the leader, and now we're worried that it's not going to be the leader going forward. But if you look around in your life, there's technology everywhere. Every new company is being developed based on technology. So I think that there's, again, another one of those secular trends that technology is going to be a leader. So I would not expect that companies like Apple or Microsoft that are doing things in the cloud or doing things with new technology are going to be the ones that are going to drag down. So that if you do see that, that's going to be a real quick sign for you that if companies like Apple can't sell an iPhone anymore and they've got no earnings anymore, that's going to be a real serious problem, right? So I would expect that what you'll see is the things that are being dragged down will tend to be those that are maybe more from a younger type of company that has maybe a lot of growth potential, but not maybe a lot of products like Apple or Microsoft or Amazon have in terms of major revenue streams to help them weather a bad set of time like that. That would be my expectation.
And maybe answer in the context of the separately managed accounts, right? So it's notoriously difficult, obviously, to from a risk profile for some clients to put an inverse fund unlevered. I would agree, by the way, is a better way of expressing a bet, because you don't have the path dependence issue of the daily reset with the leverage and volatility. But talk about that in terms of when you yourself are feeling particularly bearish, independent of your stock picking ideas. Are you expressing an outright inverse bet like that?
Yeah, so I think that that's definitely a better way to do it than with the levered ETFs. But you still have problems with the costs involved with the inverse ETFs. You've got market makers, you've got those that have been preferred providers that are helping create and redeem the ETFs, and there's costs involved with that. So it's not going to be perfect either. My perspective, again, I'm an options guy. So for me, if I'm going to make that outright bet to the short side, I'm going to buy puts. I'm going to buy SPY puts, or I'm going to buy triple Q puts or something like that instead. Now, on something like the ARK fund, Yeah, I don't even know. Can you? I guess there's probably options on the ARC fund. I haven't been
Yeah,
all
they
that
actually
involved
even
with
have
ARC.
So
By the way, I find it to be utterly bonkers. No, really, because I keep going. It's like options are difficult in and of itself, just because you have a time limit, right, with options. But then
Right.
on top of it, now you've got to figure out the path in between the time limit. That just seems utterly insane. The path dependency aspect seems utterly insane to me.
Yeah, I think it goes back to the old adage: if Wall Street can sell it to you and make money, then that's going to happen.
That is 100% true, unfortunately. And I say unfortunately because, you can't blame those that are creating the products because they're trying to, essentially get, some revenue from demand that they're seeing. Otherwise, why would they launch it? So it's always a question of, are these vehicles good for the end investors or not? But, sometimes it's the end investors wanting those poor vehicles. That's the problem, not necessarily the issuers.
Exactly. Yeah. For me, if it's a bet that anything is going to go short, it's going to tend to be a short-term bet because I'm of the belief that as kind of the statement that Michael made to start with, stocks over time go up. Maybe not ARC, but for the most part, individual stocks over time go up. So if I'm going to make a bet to the downside, I'm going to look for something that's got a very high delta in it in terms of a put option. It's probably going to be just maybe at the longest a 1 month expiration before it's in there. And then I'm going to take a look and say, what's the premium I'm going to pay? And I'm going to limit the premium to the amount that I'm willing to lose as a bet on that trade. Yeah. So again, I go back to the options market, and there's option strategies that you can use to capture some of that downside. So where the premium that you're actually spending is kind of low. So everyone probably knows about the really out there in the market bets that have been created by some famous people like Taleb that say just buy those deep out of the money SPY puts and buy a lot of them. So if there's a crash, you get a lot of money out of it. But the other way to look at that is say, combining options and the technicals and say, where do you see that there's been battles from a technical perspective? Where is there been a real battle between buyers and sellers? And if you look at things like ARC, for example, where it had the 2020 low at about 32, and then it came back down to about 36 for the low in June. Perhaps maybe your protection, your hedge against owning a position like that is put options that have a strike price somewhere around the 35 area to get most of that risk below that something just insane happens. And there's going to be some cost to that. And ARC is a pretty volatile name, so that you're going to have to spend a lot for that. But you can mitigate some of that cost by putting on some kind of an option spread structure to reduce the cost as well. I like to describe option spreads instead of like vertical spreads or horizontal spreads as I want to buy an option that I see as the driver of the trade. So for this one, it would be protection, buying that 35 put. And then I'm looking to see how can I fund that at a much lower cost. So I'll look to see, are there other key areas in ARC's history where there's been battles, and there really haven't been any other battles down till you get down to about 22, 23, somewhere in that range. So maybe look to short a put at the 23 range so that I'm limiting the potential downside that I can hedge, that I can benefit from a hedge. But it's based on where I've seen previous volume to do something like that. If I don't get enough out of just a single hedge like that, I might put on some kind of a longer structured trade like a butterfly that allows me to sell multiple options on the downside and still limit the risk.
I think we should definitely explore more on the option side for a future conversation with maybe a couple other thought leaders I've had in the investment space. Everybody here again, please make sure you follow Greg. And I apologize again for this being somewhat truncated, but hopefully this was worthwhile for everybody here. And Greg, you and I will be in touch. Appreciate everybody joining. I'll have another space tomorrow with Joseph Brown, and enjoy the rest of your nights. Thank you, everybody.